Hello, everyone. How's everybody doing? Hope you all had happy Easter. All right, so today we're actually not talking taxes. We're talking financial statements. We're talking accounting. We're talking the if we are business owners, how can we read the financial statements? Do we have financial statements? What does it mean for me to have financial statements? How can I read them? What do they represent to me? If I have a business and my accountant is asking for the financial statements to prepare the tax return, what do I provide them? And if they're the ones doing the bookkeeping for me and doing the financial statements for me, how can I read them? What does it mean to me? Does the money in the bank is it a good representation of my financial position? Should I be looking at something different? How does that all play in my financial growth, in my financial position? And how can I benefit from that? If I am a business owner, I need to know this stuff. Even if I'm not a numbers person, even if I don't like numbers at all, or this all doesn't make any sense to me, that's where we're here for, to educate you, to give you an idea. And this is part of what I do with my clients. I sit with them at least on a quarterly basis and we talk numbers, we talk financials. I show them what is their financial position and how does that work for them and how can they use these numbers as indicators for growth. All right, so let's dig in. I'm gonna share my screen with you. And we'll start. All right, so yeah, today we don't have a presentation, but we have this financial statements for a sample company. It happened to be a design landscaping, but you get the point. Like you're gonna get the better high level understanding of how your financial statement should look like and what does it mean for you. All right, so first thing we're gonna look at is the balance sheet report. Actually, somebody asked me before, and it was a 1040. It wasn't a business owner, and it was a 1040 client, and it was asking me, if I look at the tax return, will I be able to know what do I own? And the answer was no, because the 1040 or the tax return is not a report of assets. It's not a report of what you own. It's only a report of income. But when it comes to businesses, you get to see both. So the balance sheet report, in very simple terms, is a statement of your financial position, including what you own. What you own is like your assets. So it has three main three main titles, three main accounts, and then there are sub accounts. The first one is the assets. The categorization of your accounts on the balance sheet is your assets. Assets is what you own. It's your bank account, is what you got in your bank account. It's your receivables. It's like what's your invoicing to your clients or your customers, and your inventory if you happen to have ones, and so on. These are, we call it current assets, but then you have also fixed assets, like if you have vehicles, if you have buildings, if you have equipment, if you have machine, this is where it would show. So this here is a report that shows your assets, what you got. All right, so this is the first part of the balance sheet. Like if you look at certain point of time, whether it's at the end, this is year to date, for example. If I change this to last year or this year, I get to see as of this point, this is how much do I have in the checking account. This is how much I have in the saving account. The balance sheet is an accumulative number. This is what you've got from inception to date, as of. You see here where it says as of this date, this is how much of assets I have and I own. All right. But what about liabilities? It also shows here. So if I got a building, but the building was on a mortgage, or I had a loan, or I still owe my vendors payments. So this is where it would show in the liabilities section. And it's same thing. You have current liabilities, and current means that you have to pay it within a year. Basically and mainly accounts payable. This is what you do for day-to-day operations, credit cards, and you may have other current liabilities like payables to estate, like if it's a payroll related liability, or estate tax payable, or something, or sales tax, or some sort of payables that you have to pay within a year. And then you've got the long-term liabilities. If you have a note payable, line of credit, mortgage, any of that, that would also show here. So that means if I just do collapse all of these, condense them all together, that means I have assets of $23,000, but the bad news is I have a liability of $31,000. That means I have a negative equity in my business. I have a negative equity in my business, but if the numbers of assets I had was higher than the number of liabilities, that means I have positive equity in my business. And maybe another time we can go through, if you have a negative equity, would you be able to take the losses? We're talking about like basis. Something that you may have heard from your accountant, oh, you're having losses, but you're limited because you don't have enough basis in the account. And you get a shock. I have the losses and I'm not able to use them. Why? Because mainly you had more liabilities than your assets, and that's one factor that goes in there. All right, so the equity part would be your assets minus your liability. This is mainly your capital account, your equity account, including in it your net income. This is what we're gonna see on the P&L, profit and loss statement, and the retained earnings. These are the accumulative earnings that you get from one year to another, and this is basically you wouldn't see this in a bank in a clean financial statements, but yeah, we'll definitely have to clean this, but that most likely would have been like distributions, shareholder distributions, or would be a reduction of your retained earnings. So you were accumulative, actually you're accumulating losses year after another. That's why your assets, what you've got in the bank and what you've got in fixed assets and all of that are less than what you owe in loans and payables and all of that. All right, so that's the high level balance sheet that can tell you whether you're in a good position, you're in bad position, you should what you should consider in terms of like planning for getting more financing, or what's the plan. All right, next comes the P&L, the profit and loss. And the profit and loss is not an accumulative like the balance sheet. This is showing you for this period of time, only from January 1st, 2025 till April 24. Or if I got it for the whole year, or maybe last year. If I take a look at this year, the numbers should not matter anyway for this year or year to date. But if I take a look at last year, it would be different. But here, the profit and loss is for a certain period of time, from January to December, from January to April, January 2024 to December 2024. It doesn't tell me how much was the profit and loss last year, or the year before, or so on. It's not an accumulative. You have to run the report for each single period of time that you want to take a look at. It's kind of like a snapshot, right? Snapshot for how did you do during this period of time, a certain period of time. So, and usually always starts with your income. So since this is like, of course, the chart of accounts here would be different for a medical practice owner, would be different for a daycare, would be different for landscaping. So the chart of accounts would be different, but you get the idea. It's about the same. It starts with income. Here you list your income, your types of income if you have more than one classification. And then this is all total income. And then you have cost of goods sold. And this is especially if you have inventory and if you are having, this is the cost of goods sold, as it actually said, self-explanatory. So this is the goods you sell, but this is the cost of it. And you supposedly sell it at more than the cost. You sell it at a profit. So we record in the income here, the gross portion, and then here the cost portion. So what we get is the gross profit. The gross profit is the total profit, the total revenue I received minus the cost I had, the direct cost that I had for the goods or services that I sold, and then that gives me the gross profit. And from there, I start to deduct my other operational expenses like advertising, auto expense, equipment rental, insurance, whatever it is, legal and professional, repair and maintenance, rent, utilities. All these are my operational expenses, and from the gross profit, I deduct all these expenses, I get to the net operating income. And there's usually another part for other income and expenses. Other income and expenses, like it's not related to the activity that I perform. So meaning if I am medical practice owners and I have medical services and all of that, this is income. But if I also earn interest on money that I have in the bank, so that's called other income. It's other income that I get that's not directly related to the services that I provide. So interest, dividends, things like that, this is where it goes in other income. Other expenses also falls in the same period. It's expenses, but it's not related to the operations of my business. So again, this is, if we condense that here to take a look, this is, instead of going like one by one, this is your total income. Here, your cost of goods sold, it may not be applicable to everybody. You may not have cost of goods sold on your PL. And then your expenses, your operational expenses, you get to your net operating income. And from there, you add and deduct your other income and expenses until you get to your net income. And you get to take a look here. It's a profitable here. That means it's doing good, since it has this number is positive. In other circumstances, it could be a negative number. It could be that the revenue I'm receiving is way less than my expenses. So it's always good to take a look at this to see how am I doing? Am I at profit or am I at loss? Do I need to cut some expenses? Are my expenses like reasonable? Does it make sense that I'm spending that much on advertising if I'm getting that much of income? And so on. You do your analysis based on these numbers. That's why you can't really grow as a business without understanding all of this and without understanding these numbers. So you need to have an idea. We're not saying that you have to be number savvy, but we're saying that you need to understand what does it mean that you have that much of revenue or expenses. And another thing is to start comparing year to year, month to month, quarter to quarter, because that's how it can help you to grow and to see where you're lacking efficiency. All right, then comes the statement of cash flow, and just to go back a little quick here, the balance sheet and P&L is what usually your accountant would ask you for to file your tax returns. The balance sheet is not required in a lot of cases. Like if you're doing less than 215 gross income, then you don't need to provide the balance sheet. If you're a single member LLC or if you're a sole prop, you don't need to provide a balance sheet. Your profit and loss is what matters most, because the tax return is mainly it's about how much income you made. It's about how much taxes you have to pay. But the balance sheet is required as an informational informational return that you have to provide if your gross income is more than 250, or if you're not a single member LLC or a sole prop. And then comes the statement of cash flow, and this is more of an internal report that you need to look at also to understand how are you doing. This is a statement of your cash flow. How's your cash flowing? It's usually, it has two way of representation. The way it is represented here is starts with your net income. This is how much net income you have. And if you look at the three reports, this number is the same. See, net income here is the same as the net income here, as long as we're looking at the same period. We're looking at this year, and this is exactly the same net income here. Just a quick note here. And back to the statement of cash flow, you start with the net income, and then you do some adjustment to reconcile your net income to net cash. And something also to note here, the statement of cash flow is usually divided into three main categories. Operating, this is the cash that you generate from your operating activities, from collecting receivables, from paying your payables, from selling your inventory. This is all your operations. And then another section is investing. This is like if you bought a truck, or if you bought a fixed asset, like a long-term kind of asset, this is more of an investment. It's not operational. It's not something that's a day-to-day expense. So that's investing. If you're investing in another business, that would fall here. Financing is more when you get financing for your business. So if you're getting a loan, or if you're adding capital, like if you had to put in more capital, if you had to pay yourself. So this goes here in the financing activities. So all gets add up here, and at the very end, this would be the cash at the end of the period. This is the cash at beginning of the period, and this is the cash at the end of the period. And this should be this should be matching what you got in the bank account as of this period. Yeah, depends on the cash at the beginning and cash at the end. So this shows you, okay, I started with 4,700, but now I have 4,063.52. Why? What happened? The difference here is broken down into three categories: operating activities, investing activities, and financing activities. And again, this tells you, okay, so now I'm at a positive cash, mainly not because of operations. I'm doing on operations, I'm doing fine. I have like $2,000 in positive. I added this $2,000, but investing, oh, I spent $13,000. It's not a bad thing. It's investment as long as it's paying off at the end. But where did I get that from if I only generated $2,000 from operating? Guess what? It was mainly from financing. I probably had to put in cash in there from my personal account, and probably had to get some loans from here. So that tells you, and okay, why do I have a positive balance in the bank account? Is it because I'm good in my operations, or I got it from other sources like financing? So it helps you very, very much in determining, okay, this is how my business doing. It helps you find out whether you're doing well actually in your business, or you're mainly relying on your financing. And what's your plan? Next comes the planning. Okay, what's my plan to pay off this loan? Or maybe I don't need to if I'm doing more, if they're doing better on the investment. So this is just the starting point to understand this and to take a look at that. It's a starting point to see how can we plan and how can we grow as a business. All right, so that was the goal of today's presentation is just to give you an idea about how to read your financial statements, how to ask questions, and how to see if something doesn't make sense. Like, oh, why did I collect here? I only collected 48.79, but the account receivable had maybe 100,000. So something is wrong. Maybe I need to get on my billing and do more collections and so on. So there is a lot to talk about. Maybe in future presentations, we'll talk more about how to analyze these financial statements to get to where we want to be. Because this is, again, the starting point, but from there, we get to make decisions after analyzing and after knowing what will be best to do. All right. Please tell me if you found this to be helpful, and if you want to dig in more into analyzing your financial statements, see how you're doing, and figuring out where you may have a problem, and grow from there. All right. Thank you. Have a great night.